Okay, thank you. Thank you. Um, Another question before we start? No. Okay, fine. Okay. Okay, so when we speak about capital markets, we in fact speak about four different what we call segments, what we call markets, if you want. First is spot market, then forward or futures market, then options market, then swap market. And we will go inside each of these markets. But before, and sorry for people who know that very well, and if everybody knows that very well, you tell me, you send me a chat or a message or you speak, and I will explain roughly what is each market. Spot market, or also cash market, it's a it's a market on which you determine the price immediately and you receive immediately the asset, the commodity. For instance, if you buy euro dollar on the spot market, euro dollar, euro against dollar, and imagine the spot price is 1.20. 1.20, it's the price of the euro dollar today. Around it's 1.18, but imagine 1.20. If you buy euro, you will receive 1 euro spot on your account, and you will pay for that $1.20. And it's a spot operation between you receive immediately the euro and you pay immediately the dollar. In fact, it's not exactly immediately, because people who work in banks here among you know that we have some question. It's for instance, one day you have a delay of one day for receiving euro, for instance, but it's what we call a spot operation. Okay, if you buy, for instance, an equity on the spot market, you want to buy Amazon, the equity Amazon, you pay for that, I don't know, $100, and your account will be reduced immediately by $100, and you will receive immediately one equity Amazon. It's spot operation. Okay, that's very easy, and you know that. Okay, second kind of market on the right here, it's what we call forward and futures market. What is a forward or futures market? It's a market on which you determine today price for delivery in the future. Let me give you an example. I am a producer of cakes. You know cakes because it's dinner time, and maybe you are hungry, so you know what is cake, because maybe you are eating cake during my conference. Okay, but how do we produce cakes? With butter, with sugar, with flour. It's with wheat, for instance. And if you are this producer of cakes, you have a risk that the price of the commodities moves up. And as you know, for some weeks, the price of commodities is increasing a lot. Wheat, sugar, cocoa, coffee. So you are a producer. You want to hedge to cover your exposure, because as you will buy sugar in the future, in 3 months, 8 months, you want to fix today, to lock in today the price at which you will receive the sugar in 3 months or 8 months. That's what we call a forward or futures operation. Okay, a futures market is a market on which you lock in today prices for delivery in the future. If you want to visit France in 1 year, our currency is euro. Imagine your currency is dollar. You have an exchange rate risk. If the euro dollar moves up, you will pay more with more dollars, 1 euro. What can you do? You can go to your bank, maybe not you, but if you are a firm, and say, I would like a forward rate. I would like to buy euro forward, expiration date 1 year, at a price you will give me today. And the forward price will not be the spot price, sure. There is a connection, a link between forward price and spot price. We will see that after, or maybe you know. Okay? So that's a forward operation. You have foreign market for commodities, for currencies, for interest rates, for equities. Imagine you will earn a lot of money in 6 months. And with a huge amount of money you will receive in 6 months, you want to buy Amazon equities. You have an equity risk. If the price of the Amazon equity moves up, you will pay more. So you can hedge your exposure by locking today the price at which in 6 months you will buy Amazon equity. It's a forward price. Okay? So these markets are very used. I don't know in Vietnam, but in United States, in Europe, in Great Britain is no more in Europe, okay? We use frequently, continuously these markets. Forward and futures, these markets are slightly different. I will explain later, but just a foreign market is a market on which you trade with an individual counterparty, maybe a bank. If you do the same operation on an exchange, it's named a futures operation. So forward futures, the difference is just forward is when you trade with an individual counterpart, and futures if you trade on an exchange. Third market in which we will go, options market. I have been working a lot of time on a partly basis in an investment bank, which name was Indosuez. Maybe some of you knows because it has Asian origin. And when I work partly with Indosuez in the research trading room departments, we traded a lot of options, and really it's a derivative I know the better, and it's a marvelous derivative. Really, you can make a lot of things with options. Before going to how price options, how to use them, we will see that after. Just one word for people who don't know what is an option. An option is what we call a derivative. It's the right to buy, it's named a call, or the right to sell, it's named a put, an asset in the future at a given price, which is called a strike price. Okay? So an option is, and it's different with a forward, because a forward, you are engaged, you are obliged. If you buy euro dollar at 1.20 6 months, you are obliged to buy the euro at 1.20. But if you buy the right to buy the euro at 1.20, if the euro dollar crashes, reduces, moves down and go to 1 instead of 1.20, you have the right to buy at 1.20. You don't buy. You buy at 1 instead of 1.20. So that's an option, the right to buy or the right to sell. And when you buy an option, you pay. what we call the premium of the price of the option. Okay? And there is, for people who know that, a lot of books, articles on option pricing, how to price an option. What's the price to buy, I don't know, something, Amazon equity at 100 in 3 months? What is the price? This price depends on a lot of variables, among them the volatility. It's a dissipation of prices. And then last markets, the swap market. What is a swap? Because I here in France and in Europe, students generally know a lot on spot, forward, maybe options, and really they don't know a lot about swap. I don't know why, because we don't teach a lot swaps. And swap is a very huge market, huge in terms of volume traded. What is a swap? A swap is a contract, it's a financial contract. So when you make a swap, you make the swap with an individual counterpart, a bank, for instance. And what is a swap? Is a contract, financial, by which you will exchange two flows, different flows with your counterpart. What kind of flows can you exchange? The swap, which is the more traded in the world, is what we call interest rate swap. Interest rate swap. What is an interest rate swap? It's, for instance, you have a debt because you are a firm, you are in debt, you have a debt, you borrowed on a variable basis. What does that mean? You borrowed, for instance, $1 billion, 1 billion, because you are a huge firm, on a variable basis. That is, each 6 months, you will pay the LIBOR, the variable rate, each 6 months. So you have an interest rate risk. If the 6 months interest rate in dollars moves up, you will lose a lot of money because your interest will move up. So you would like to go to a fixed rate debt instead of variable rate. What do? You can discuss with your banker and say, okay, I have a debt with variable basis. I would like to go to a fixed basis. But the bank maybe will discuss with you 1 time, but not 2 times. The best thing is to make a swap. You keep your debt on your balance sheet, variable rate basis, LIBOR 6 months. But you make a swap with another bank or with the same bank, but it can be another bank. And you say to the other bank, I will make a swap with you. Each year, I will pay you a fixed rate, for instance, 2%, and each, in counterpart, each 6 months, you will pay me the LIBOR rate. So what happens? On your debt, which remained on your balance sheet, you pay every 6 months the 6 months interest rates. On the swap, you receive each 6 months the 6 months interest rate. So the two flows cancelled. And you pay the bank in the swap the fixed rate. So globally, a variable rate debt plus a swap is equal to a fixed rate debt. Okay? So you have a lot of swaps because you can exchange a lot of things. Okay? And we'll discuss about what we call, for instance, credit default swap, CDS, which is a very important instrument which played a very important role in the Greece crisis in 2012. What is a credit default swap? It's a swap. You pay something, you pay a flow, for instance, 2% each year. And in case of default of a company, you will receive the nominal value of the bond, for instance, you're hedging. Let me just coming again. You have a bond. Everybody knows what is a bond. You have a bond. You are an investor on I don't know an airline company, Air France, which is as you know a big airline company, but who has some difficulties at this moment. So normally you have a bond and you receive a coupon every year from Air France, and after in 10 years you are reimbursed the nominal value. But you think that Air France will default. Some people here in France say, be careful with this company, because big airline companies defaulted in the past history. So Air France could default. If you think that it's possible, you have a bond issued by Air France. You want to transfer the credit risk. You don't want to keep this bond. You can sell it, but you can also keep it on your balance sheet, asset side, and say, I will make a swap with the bank. I will pay 2% each year, and in case of defaulting, in case if Air France defaults, the bank will pay me the nominal value of my bond. So I am hedged. I have no more credit risk. It's like an insurance, if you want. But it's different, and I will explain after, not today, but after. Okay? So here, credit default swap is very used. And I for another reason, I checked this morning. For instance, if you want, the 5 years credit default swap for Air France is today traded at around 5%. 5%. That is that if you want to hedge your credit risk with Air France, if you have bonds issued by Air France, you must pay 5% each year to your bank. And if Air France default, the bank will pay you the nominal value. But we have to pay 5% of this nominal value each year. That's very high. And there is obviously a connection between the price of the CDS, it's 5%, and the default probability. And I will explain you how we can extract from CDS price, 5%, the default probability of Air France. One way of measuring default probability of companies is to use their credit default swap price. Not every company has a CDS traded on the market, but the big companies have CDS. Okay? So, if I want to make a summary of this first, of the introduction, 4 segments in the capital markets. 4. I don't know where is 4. Spot market, forward and futures market, options market, swap market. And these markets are used by companies to hedge, to cover their risk. And I will explain how they can hedge their risk when using all this market. But before, what is very important is to know how the price is determined on each market. How can we compute a forward price? How can we compute an options price, etc.? Okay? So, before going further, Can you tell me if you understand, if it's too easy, too difficult, if my English is not understandable, if you cannot understand, if it's clear? Please tell me. We spend 1 minute. You can send chat if you want, if you don't want to speak. Can you tell me something about the way we are? Nobody. Ah, 1, 2, 3. It's clear for me. I love the class. It's clear. It's quite clear, very clear. Okay, I suppose rightfully you find it's clear, and you can tell me it's not clear, okay? Because it's not okay. Okay, but if it's clear, it's clear. Okay, other slide. Oh, yes. What are the assets traded on, for instance, the spot market, the first segment, spot? What can we buy or sell spot? 4 kinds of assets. Either equities. I can buy or sell spot equity. I repeat that buying spot and equity is just paying immediately spot. Okay, you pay $100 and you receive immediately the equity. So it's a spot operation. But you can also do the same thing forward. You can lock in today a price for buying instruments and equity. Second class of asset, interest rates. You can borrow or lend money at a spot rate. What does that mean? I am a firm, I want to borrow from my bank, and my bank tell me, okay, I make you a rate of, I don't know, 10% over a 10-year horizon, for borrowing over a 10 years horizon. And you borrow, you will pay each year 10%, and you borrow immediately, not immediately, maybe in 2 days or 1 day, the amount you borrowed. And in 10 years, you will reimburse. That's a spot operation. But you can also borrow on the foreign market. What does that mean? Imagine you want to buy a marvelous house in 2 years. You say, okay, in 2 years, I will buy a house in Hanoi or in Ho Chi Minh. I have a very nice house I want to buy in 2 years. But I have an interest rate risk. If the level of interest rates move up between today and 2 years, okay, I will have to pay a higher interest rate. I will lose money. So I want today to lock in an interest rate for borrowing over a 10 years horizon in 2 years. It's what we call a forward interest rate, FRA, forward interest rate. That is, you determine today's interest rate at which you will borrow in 2 years over a 10 years horizon. Okay, so I will explain after that in United States, in Europe, the level of interest rates is so low. Maybe some of you know that we have on the treasury bonds in the Eurozone some negative interest rates. You borrow at a negative interest rate. Maybe it's very, we don't understand how banks can lend with an interest rate, a negative interest rate. Yeah, I don't understand. The bank is really full. No, I will explain after why we have negative interest rates. Okay, so you can borrow land on a spot basis and also on a forward basis. What can we buy and sell spot? Currency. I can buy euro against dollar on the spot market. And then commodities. I will speak a lot of commodities because it's a very interesting market. Spot, forward, option, commodity swap. I will explain how we can make swap on the commodity market. And here we are on the spot. That's very easy. If you want to buy uh, wheat for preparing your cakes, you buy wheat to a farmer, you pay immediately, and you receive immediately the wheat, and you go to house for preparing your cakes, and you send me your cakes because I love cakes. Okay, so you have a spot market. And when we speak about commodities on the financial markets, we distinguish, we make the distinction between three class of commodities. What we call energy commodities, it's oil, it's electricity, etc. It's gas. Second asset, so second class of assets, it's metals, gold, silver, copper, platinum. Third class of assets, it's agricultural, what we call on the financial market soft commodities, that is agricultural commodities. That's wheat, corn, etc. And also what we have pork bellies, which is traded on the Chicago Mercantile Exchange. We trade pork bellies. We trade many commodities, and we will go through these markets when the time has come. Okay, so if I make a summary, 4 kinds of markets: spot, forward, options, and swaps. 4 underlying assets on each market: equities, interest, commodities, and currencies. Okay, 4 kinds of markets, 4 kinds of underlying assets. So if you multiply 4 by 4, it's already 16 different markets. And all these markets are integrated. They are not, they are really connected. We will see that after. Okay, no chat. Okay, maybe we will see after. Okay. After spot, we have forward market. I explained you some minutes ago the difference between a forward market and a futures market. I told you that a forward market is when you trade with an individual counterpart. You are able to buy forward wheat to a farmer. It's forward trade. But you can also buy wheat on the Chicago Mercantile Exchange, which is an exchange, okay? And in Chicago, we trade wheat also. We trade rice. We trade many commodities. You can buy in Chicago. Okay, so it's a futures market in this case. And what you immediately think is that the price of the void price is not very far from the futures price. The 2 markets are very connected. Okay, it's not exactly the same price. You have delivery questions, but roughly the same. Okay, and these markets, forward and futures, are connected with the spot market. Let me, before going in further details, it's just an introduction what we are doing now. Let me ask you a question. If you are a cake producer If you are a cake producer, you need butter, you need wheat, maybe you need cocoa. What do you need also? Wheat, butter, sugar, and cocoa, for instance. 4 commodities. So if you work in the agro industry, if you are a cake producer, you have really a very high commodity risk because you determine the price at which you will sell your cakes. Okay, but your cakes you produce every day. So if your price has been defined for 1 year, for instance, and when you produce your cakes, if the price of cocoa, wheat, sugar moves up, you lose money. So how can you hedge? Let me begin by, for instance, butter. For producing your cakes, you need butter, fresh butter, very good butter coming from cows, from very nice cows. Okay, so you are now, and you say, I think that the butter price will move up. And you know, the volatility of the butter price is very high. In Europe, because I have been working a lot for a French company which was producing cakes. So I have many examples. And in less than 1 year, the price, it's not this year, but some years ago, the price of the butter price has been multiplied by 3. And so the company has sold her cakes to stores at a fixed price for 1 year, and when it produces the cakes, okay, the butter price moved up, has been multiplied by 3, and they lost a lot of money. And it's the reason why they help and they say, oh, can someone help me to hedge my butter risk? Not interest rate risk, not currency risk, but butter risk. And I've been working with them. I have a question for you. If you want to be hedged against the rise of the butter price, what can you do? What can you do? You are working in the financial department of a cake producer, and you want to be hedged, to be covered against the rise of the butter price. What can you do? Maybe you can already answer or by chat. I have a would sign a long-term contract with a butter supplier that provides stable price and amount. Okay, I like this answer. Does everybody see the answer? Yes, everybody sees the answer. Oh, no. Can you say yes or no? Can everybody see the answer? Give it yes. Okay. So you would sign a long-term contract with the butter suppliers. Okay, that's a good answer. Okay. Know that it's a little difficult long-term contract. Why? Because you cannot save butter over a long horizon. So you will sign a 1-year contract with the butter suppliers. It's seldom that the butter suppliers. Oh, sorry. It's okay, but the idea is good. Okay, so a long-term contract with a price which is a forward price, because you lock into the price for delivering butter. Sorry, just 1 minute. Oui, attends, je suis en cours là. Oui, salut. Okay, sorry, because someone. Okay. Whoa. Sorry. Okay. Okay, you sign a long-term contract with butter suppliers. To my mind, in France, you cannot go over 1 year, okay, because I think that butter supplier will not fix prices or more than 1 year, okay, because okay, that's the first a good answer. What can you do also? Instead of buying forward better, what can you do? What can you do? Someone is writing. What can you do? Instead of buying forward better with a long-term contract. Okay, with this good answer. Okay, Nguyen Hong Lin Bui, I don't know if it's a good, is writing, but I don't know. I don't see what he's writing. Okay, so you can also buy the butter spot and store it and save it, store it. Okay, so another way of being protected, either you buy forward through a contract, as your colleague said, that's a good answer, or by yourself buying spot butter and store it. And normally the price has to be the same. The forward price, if a butter supplier say, okay, I will deliver you butter in 3 months at a forward price, okay, and I will buy myself, buy spot and store, the cost of buying butter has to be the same. If it's not the same, you have an arbitrage. And what is the price? What is the cost of buying by yourself on the spot market? If you buy butter on the spot market and store it, first you have to finance your exposure, because for buying butter on the spot, you have to finance to pay the interest rate, because you borrow money for buying butter spot. So the cost of buying butter, if you go through the spot market, is I borrow money, I buy spot the butter, I store the butter, and I have a cost of storing, a cost of storing, a cost of carrying your exposure. And normally, at equilibrium, we will see that after, the forward price has to be equal to the spot price plus cost of financing plus cost of storing. Okay, so the forward price normally for butter is higher than the spot price, because if you want to buy forward, either you buy forward, you sign a contract with a butter supplier, it will give you a forward price, or you do that by yourself by borrowing, buying spot, storing. And normally at equilibrium in finance, the forward price is equal to spot plus cost of financing, its interest rate, plus cost of storing. It's a very important relation we will see after. And when Nguyen Hong Lin Bai, I'm not sure to have a good pronunciation with Nguyen Hong Lin Bai, but okay, the colleague who say we would sign a long-term contract. Why did I say long-term? It's not over 1 year, because it's very difficult to store butter, because the quality property move down with time. So today we can make congelation, we can store the butter during at maximum 1 year. Okay, so if you ask a butter supplier for a forward price, the butter supplier will borrow, buy or produce butter and store it for you, and over maximum 1 year. So the forward price is not traded normally more than 1 year. Okay, maybe I have other chat. Yes, sure. Do. Oh, my pronunciation, I am not. Told me, can we long futures? Sure, we can. Either you buy forward from a butter supplier, or you sign a contract by which you say in 3 months, in 6 months, in 9 months, in 12 months, you will deliver butter And the butter supplier will say, okay, but what is the forward for the 3 months delivery, 6 months, 9 months, 1 year? Borrowing, buying spot, or producing spot, and storing. And you will pay the spot plus interest rate plus cost of storing. Or you can buy futures on the Chicago Mercantile Exchange or on a European market, which is Eurex. You can buy and sell future. We trade butter futures, okay? And normally the forward price is very close to the futures price, and is very close to spot plus interest rate plus cost of storing. That's very important. We did not go into details now, just understanding, but my hope here is that for everybody, you know that the forward market is not disconnected than the spot, because the forward price is spot plus interest rate plus cost of storing for commodities. Okay, so if the spot moves up, the forward will move up. If the forward moves down, the spot will move down, because the price of the two are correlated. Forward is spot plus interest rate plus cost of storing. Let me just give you an example. If you want to buy in 3 months an equity, for instance, Amazon, which is traded on the spot market, imagine, I don't know the price of Amazon on the spot market, which is traded, for instance, at $100, okay? Amazon spot is traded at $100, okay? And imagine that you want to buy it forward. You don't want to pay spot. You want to lock into the price for buying it in 3 months forward. You call your bank and say, okay, make me a price if I buy Amazon in 3 months. And imagine, banks say, okay, for you, I do 120. No, it's not possible. Imagine if the bank propose 120, you say, I don't buy forward, I sell forward. Why? Because the bank proposed a price of 120 forward, and the spot is 100. You can make by yourself forward. You borrow money today over 3 month horizon. You buy spot Amazon at 100, and you keep Amazon during 3 months. In 3 months, you will hold Amazon, and your cost of buying was 100 plus interest rate, which is close to zero in dollars, minus dividend if you have a dividend, but without any dividend, it's just 100 plus interest rate. So if the bank says the forward price is not 100 plus interest rate, but 120, you say, okay, guy, I will sell you at 120. And what do? You borrow money, you buy Amazon today spot at 100, and you sell forward at 120. And in 3 months, you have a lot of money because you sell Amazon at 1.20, but the cost of buying Amazon was spot 100 plus interest rate. And maybe you have a higher profit because if you have a dividend given by Amazon during this period, you will receive the dividend. So it's impossible that the banks trades at a different price than 100 plus spot plus interest rate. And for an equity, the relation between forward price and spot price is the forward price is equal to spot price plus interest rate minus dividend if you have a dividend. We will see that again. Don't be disturbed if some of you are not so easy than others. We will see it just to tell you here when you stop the session today, you say, okay, I understand. We have spot markets, forward markets. The two markets are connected. The the forward price is roughly equal to spot plus what we call cost of carry, interest rate plus storing. So just that. That's really it's enough. Okay, no chart. I just have a look. Oh, okay, it's only 3 minus 10. Okay, we make a break in 25 minutes because. Whew. Okay. Oops. Okay, what is that? Some of you, one of you say long futures. Just we don't go into details of this screen, but it's a screen extracted when I prepare my session in August 23. And it's the quotation given by traded on the Chicago Mercantile Exchange. Wheat futures price. As you know, maybe you know last price, it's fourth column, last price, okay? For wheat, buying wheat on the futures market, it's no more a forward price, it's a futures price. The difference is that it's just because it's traded on an exchange. If you buy with the delivery of September, it's 700. It's not 100, but it's 724. December 738, March 749, 750, etc., till May. After it's another crop, and the price cannot be are disconnected, because if you buy wheat with a delivery in, for instance, July, you will receive the wheat of the next crop, not today. So you cannot make an arbitrage between buying today wheat and storing till July. Can one of you explain why the prices are increasing? September is 724, December 738, 749, 754. Why is the futures price of wheat increasing? So if you buy wheat delivery in March, 222, okay? So if you are a cake producer and you think the wheat price will move up again, you can be long futures. You buy a futures, and you will pay 758. If you buy the wheat delivering in September, so now in some days, you will only pay 724. Can one of you explain why the price structure is increasing? You can speak or you can write. Nobody want to. Maybe you are eating a cake with wheat, butter. Well, not at this time. It's dinner for you. Nobody? Oh, I am so sad. Nobody wants to answer. I'm sure you know the answer. You don't know the answer, it's because I was not clear. So I have to be more clear. So, I have an answer given by T. Phong Han Lee. Oh la la, I cannot speak very well Vietnamese. Okay, let me just look at the answer. From December to May, maybe the supply of wheat is low, the demand is high. Not really, not really. Okay, what you are writing is okay, can understand, but not really. Not really. Have you another answer? Okay, if you remind what I two three do is rating. Maybe we wait for two three do. I'm not sure to be fluent in Vietnamese. The longer period, the higher. Two do is a very good. Maybe he's working in a trading room. Maybe he's a trader in commodity. Because his answer is perfect. The longer the period, the higher cost of carrying cost is cost of carry. Yes, sure. It's exactly what I said some minutes ago. If you want to buy, you are a cake producer. You want to buy wheat in May, next May, okay, in many months, next May, because you know that you will produce cakes and that you will have to buy wheat. And as you know, the price of commodities today is moving up a lot. Every commodity, okay. So you say, oh, I follow the course on financial derivatives with Mr. Marteau from France, and I will hedge my risk. Either I can buy future or forward, or I can buy spot and store. Look at this last solution. If you want to buy wheat in May, next May, in some months, you can borrow money today. Buy spot wheat, buy spot. You receive today wheat. You don't need, because it's just for May. So you store it, storage cost. And what is the price? The price will be spot plus interest rates plus storage cost. And as do writes, the higher is the period, the higher is the storage cost. Because store wheat till December is not so expensive. Till March 22, it's more expensive. Till May 2022, it's more expensive again. So the storage cost is increasing with time. If you store a commodity during 7 months, is more expensive than store it during 1 month. It's the reason why the storage cost, what your colleague, the storage cost plus interest rates moves up with time. It's the reason why, and the only reason why, the price structure of commodities is normally increasing. I say normally because we see something. For instance, today, the price curve on the futures price of oil is decreasing. And the explanation given by your colleague some minutes ago, he told me maybe the supply of wheat is low and demand is high. We will use that for oil during the session allocated to oil. Okay, so here, so if you buy, I have another question. Okay. So just to finish and after to answer to the other chats, the higher is a period, the higher is the storage cost. One question very interesting is, but then why the July 2022 is lower compared to May? That's a very good question. The only reason is following. It's a technical reason. On the futures market, if you buy July 2022, you will receive not the existing crop, but the next crop. The crop beginning in July. It's not the same commodity. The quality of the wheat is not the same. So you cannot say, I want to buy wheat in July, I borrow till July, I buy spot, I store till July, and I deliver. You cannot do that because the wheat you have to deliver is the wheat of the next crop. So the price of the next crop, July 2022, is depending more on the demand and supply forecast at this period. And it's no more linked, connected with the different. But if you look after July, September, December, it's the same crop and the price is increasing again. Okay, so be careful because on the wheat market you have a seasons effect, and when you buy on the futures market wheat, you will receive wheat from the next crop, not wheat from the existing crop. So you cannot make an arbitrage between July and spot today. Okay, new season is ready to harvest. Yes, sure. Okay. So for food, it's dependent on crop. Yes. I will maybe show you another. I have been working. It's a very strange commodity. One day, it's just a small story. I forgot to tell you that I am a professor. I work for the Bank of France, but I make also consultancy. Okay, consultancy in a firm, in a consulting firm. And one day, I was called by a small company producing smoked salmon. You know what is smoked salmon? That is salmon which has been smoked. Okay, and how do you produce smoked salmon with fresh salmon? And you smoke it. Okay, so, and this guy told me, okay, it was in, I think, September, but it was 2 years ago. In September, he calls me and saying, okay, the price of the salmon in December, because it's Christmas here, the price is moving up because a lot of people demand salmon. Okay, so the explanation given by your colleague 7 minutes ago, demand and supply, okay, works because he told me the price of the salmon spot price moves up. I want to be hedged, and I tell you, okay, you can buy a future of forward salmon. You can in September decide the price at which in December you will buy salmon. So normally the December salmon has to be equal to the spot price salmon plus interest rate plus storage cost. The only problem is that you cannot store salmon during 3 months because after, if you eat the salmon, really it's not very good. Okay, you don't have very good technical capacities for storing salmon today. So the December price is much higher than the spot price. And you cannot make an arbitrage telling that the December price is equal to spot price plus interest rate plus storage cost, because you cannot store salmon more than 1 month. Okay, so it does not work for this typical. So on commodities, you have some specificities, and my relation, the relation forward equals spot plus cost of carry, works from a global point of view, but not for every commodity. Okay, so for instance, on you have commodities you can buy or sell. For instance, metals during over 5 years. The 5 years metal price is spot plus interest rate plus storage cost. Okay. So just that's a screen with the price of the forward price. When we look in more details and forward markets and futures, I will explain you each column here. Okay, but yeah, on the first column, as you see, it's expiration date, and fourth column is the price, futures price. Okay. Oh, you can duplicate buying forward wheat, expiration date December, by borrowing money till December on the US money market, buying wheat on the spot market, and storing it till December. So by arbitrage, forward price equals spot plus interest rate plus storage cost. One of you spoke about carrying cost. It's what we call cost of carry. Normally in financial linguistic, we say cost of carry. The forward price is normally not for salmon, not for wheat over 1 year. Normally, forward is spot plus interest rate plus storage cost. So we can observe that the wheat curve is increasing till July. The July price being related to the new crop. All the details of the formula will be introduced later. Don't forget, it's just the first session. Oh, do you remember butter? On the European butter futures market, we have a butter market, yes, which is located in London. In London, you can buy butter on a futures market, so that futures price 4,000, 4,050, 60, 70, 80. So you can deduce that the difference between two expiration dates is normally roughly interest rate plus cost of carrying butter. But you can see that you cannot buy butter over a longer horizon because butter cannot be stored in a good conditions for a long time. Okay, that's futures price. What is the settlement price? I will explain after, not immediately. Crude oil futures. I can buy and sell forward futures oil. And as you know, here we have a very strange price curve because it's what we call inverted. The longer is the period, the lower is the price. That's very strange. I will explain after, not today. Just here, we look and we observe, and after we analyze. On the commodity market, when the price curve is decreasing, we say that the market is in backwardation. Backwardation. That's a technical term. If you want to be very good when you discuss with a banker, with a commodity trader, you say, oh, the market is in backwardation. And the guy will say, oh, you are very good. Backwardation, you know that, yes. Backwardation is just the price is moving down. The curve is moving down. Normally, the curve is moving up. And when the curve is moving up, which is the normal situation, okay, we say that the market is, in contango. Contango is when the futures price curve is increasing. Normally, it's in contango because interest rates and cost of carry have a cost. Interest rates, cost of financing, and cost of carry. So that's strange that the curve is decreasing, but it has a good explanation. Not today, but after. Okay, so just today we know that normally curves are increasing because forward price equals spot plus cost of carry, and cost of carry is interest rate plus storage cost. But we know now that sometimes the futures price is decreasing. I have something very important. I will explain you after. Maybe you remember in April 2020, at the beginning of the pandemic crisis, the oil price futures price became negative. Maybe some of you know that. The futures price became negative. You receive money when you bought oil. You lose money, you paid money when you sold oil. That's very strange. It's not very strange. I will explain after. It linked to the storage capacities. Okay, I will explain after. So why does the previous relation between futures price and cash price does not apply? Because the theoretical formula, which is best formula for people very good on financial markets, futures price equals spot plus interest rate plus storage cost. Everybody now understands. Minus something as an whole, minus what we call backwardation. And we will see what is backwardation. Oh no, not yet. Okay, we finished because the break, because maybe you are waiting for the break. And I understand very well. Okay, so for markets, spot, forward, options, swaps, connected market. On each of these markets, we trade 4 classes of assets: equities, interest rates, commodities, currencies. And on the option, what can we buy or sell? Because an option is the right to buy or to sell an asset in the future. Which kind of asset is underlying asset of options? Every asset. You have equity options. I buy the right to sell Amazon in 3 months. I buy the right to buy I don't know, Amazon in 6 months. You have options on interest rate. I buy the right to borrow in 2 years over a 10 years horizon. It's not a forward, it's an option. A forward is give me an interest rate if I borrow over a 10 years horizon in 2 years. That's a forward interest rate. Here is I buy the right to borrow from the bank at over a 10 years horizon in 2 years at a given interest rate, for instance, 5%. If the level of interest rates in 2 years has moved up, you exercise the option. You borrow from the bank at 5%. But if the level of interest rate moves down, you don't exercise your option. You don't borrow at 5. If the interest rate is 2%, you borrow at 2%. It's an option on interest rate. Currency. Does it exist an option which is a right to buy the euro dollar at 1.20 in 2 years, in 6 months? Sure, obviously yes. An option on currencies and commodities. You will ask me by chat or orally, do you think it exists options on oil? I buy the right to buy oil in July 2022 at $70. Do you think it exists an option on oil? Whoa, my voice. You tell me yes, no. Nobody wants to answer. Can you buy the right to buy or to sell the oil at $70 in 3 months? An option on oil. Does it exist? Oh, a lot. Yes. Okay. Yes, sure. You have options on commodities. So you can make a lot of things with options. It's very interesting. Very interesting. If you are an airline company, Vietnamese Airlines, and they have buy kerosene, which is energy linked to oil. So if they want to hedge against a rise of oil, they can buy an option. They buy the right during the 2 following years to buy their kerosene, their oil, at a $70 per barrel price. If the oil price moves up to $100, the Vietnamese airlines company say, oh, no problem. I have the right to buy it at 70. I exercise my option. Okay? In fact, you will not buy oil from your bank because the bank does not produce oil, but the bank will give you $30. So it's what we call cash settlement. If you buy an option on oil from your bank, you are Vietnamese airline, okay? Vietnam Airlines, sorry. So if the price, and you say, I buy from you the right buy at $70 per barrel. If in 1 month the price is 100, the bank gives you 30, and you buy your oil at 100. 100 minus 30 is 70. If the price of oil moves down, for instance, at 50, you have the right to buy at 70. You tell the bank, oh, no, I don't exercise my option. And you buy your oil at 50. If you have bought forward at 70, and if the price moves down at 50, you have to pay the bank 20. You pay your oil at 50, on the spot market, and you receive and you pay to the bank 20. 20 plus 50 is 70. It's buying forward. Option gives you the right to buy. That's really a marvelous financial instrument. Okay? And as some of you tell, yes, you have option on each commodity. On each commodity. Okay? I will explain after that you can also buy and sell forward weather, temperature, raining, because a lot of companies have a very important weather risk. Let me give you an example. If you are a beer producer, the consumption of beers depends on the temperature. When the weather is hot, people drink a lot of beer. If the temperature is down, people don't drink so much beer. So if you are a beer producer, you have a weather risk. Your risk is that the weather is lower than forecast, than expected. What do? You can sell the temperature forward. Oh, that's strange. No, that's not strange at all. For instance, in some banks in France, trade temperature. So you are the beer producer, and you say, okay, I want to hedge my weather risk for the next summer, for instance, and I would like to sell the temperature next August 2022. Imagine the bank says, okay, my forward temperature is 24. So the beer producer says at 24 to the bank. Imagine now that next summer, the spot temperature, the observed temperature, is very low, 20 instead of 24. Consumption of beers is very low. So the company loses money because it sells lower beers. But it sold forward the temperature at 24. The spot price is finally 20. You ask the bank to give you sold at 24, you buy back at 20, you have 4 degrees gain, profit. And in the financial contract, fine, for instance, you said 1 degree is equal to $10 million. So you lost $40 million because you sold lower beers, but you have a gain of 4 degrees times 10 million is plus $40 million on the financial contract. So you can buy or sell forward temperature, or you can buy or sell an option on temperature. I buy the right to sell you the temperature at 24 degrees. It is a market. You can buy and sell the temperature. But sure, the relation I explained, forward is spot plus cost of carry, has no sense. You cannot say the temperature forward traded in France next summer is equal to the spot temperature today, plus interest rates, plus storage cost. It's stupid. You cannot hedge by borrowing, buying spot temperature, and store it. That's stupid. So here you have to require to recruit people from meteorology, from climatology, who are working in trading rooms and who make some forecast about the next temperature. Okay, and you trade forward temperature with help of meteorologists. Whoa, my voice. Maybe you can speak a lot because in order to avoid the problem with my voice. Okay, before the break, beat the break. Oh, that's options I will see after. Swap market, maybe after the break, we will just explain the different kinds of swaps. But what is interesting here is that each class of asset, equities, interest rate, currencies, commodities, even credit, is an underlying asset for swap. You have commodity swap, equity swap, interest rate swaps, commodity swap, credit default swap. Okay? So before the break, and I think you will have your dinner quietly, and I will maybe drink some tea. Uh, 4 markets: spot, forward, options, swap. 4 classes of assets: interest rates, commodities, currencies, equities. Each class of asset is traded on each market. You have options on equity, interest rates, commodity. You have swap, equity swap, commodity swap, interest rate swap. So you see, in fact, if you understand that you have 4 different markets, 4 different assets, and that each asset is underlying asset of each market, you have already an idea of the globalization of capital markets, okay, of all the segments, and you see that these markets are closely connected. Okay, so I propose to make a break during what is the length of the break? Can we make what, a small break and maybe 15 minutes? And in order to stop maybe a little before 10 o'clock for you, is it okay for you? Maybe a chat, maybe someone is speaking. Is it okay for you or not okay for you? Ah, 2 people are writing. Yes, it is. Okay, so we make you. Okay, that would be. I understand. I understand. And productivity is very important, and I know that the productivity decreases with time. So we make a small break of 15 minutes. In 15 minutes, I begin again, and we try to stop 15 minutes after the end. Okay. So see you in 15 minutes. Okay. Can we start again? And do you hear me? And someone chat and tell me yes or not. Yes, off. Okay, fine. Yes, sir. Yes, off. Okay, that's great. Okay. Do you have any question before we go to swaps about what we said earlier? I don't know your voice. Maybe you can speak or you can just chat. No, nobody. Okay. Um, okay. So going to swaps now. Ah, someone wants to speak. Yeah. Do you want to speak?
No, I just want to say hello to Professor. That's all.
Oh, hello to Professor. That's okay. Hello to do. What is your name exactly? How do you pronounce do? How do you pronounce
Just call me Tui.
Tui?
Yes.
Tui.
Yeah.
Okay, Tui. Very good. Is it okay? Is there any problem? And does someone want to speak except Tui? Nobody. Okay, nobody. Okay, about swap. A swap is what we call a derivative also. That's a financial contract between two counterparts, a company and a bank generally, or two banks uh, between themselves. It's seldom between two companies. It's essentially a company and a bank. And when you decide to exchange flows in the future, you make a swap. And depending on the flows you will exchange, you have different swap. Let's begin by interest rate swap, IRS, interest rate swap. What do we exchange? What do we exchange? In an interest rate swap, we exchange normally a fixed rate against a variable rate. I had explained 1 minute, some minutes ago. Imagine you are in debt, you have borrowed on a variable rate basis, and you pay an interest which changes every 6 months, and which is a LIBOR 6 months in dollars. So every 6 months, we look at the 6 months interest rates on the market, and you pay this interest rate divided by 2 because it's 6 months. And you pay that on your debt. Imagine now you want to go to a fixed rate debt because you think that the variable rates, the short-term rates will increase, will move up, and you don't want to pay a higher interest rate on your variable rate debt. So you keep your debt on your balance sheet, but with another bank, maybe the same, or another, you decide to pay fixed and to receive variable. So each year you will pay, for instance, 5%, and you will receive the 6 months variable rate each 6 months. So now if you add your debt with the swap, you are in debt on a fixed rate basis. And if you want to go from a variable rate basis to a fixed rate basis in 2 seconds, you just make a swap. And if 2 hours after, 2 days after, 3 months after, 5 years after, you want to come from fixed rate debt to variable rate debt, you make another swap, paying variable rate, receiving fixed rate, and you will be in debt on a variable rate basis. Okay, so the swap, interest rate swap, is a way to change your debt when you want, okay, at any moment from variable to fixed from variable. And now if you look at my picture, you can also okay, I try to use the tools, but I'm not very easy, comfortable with the tools of the system. Okay, but okay. Imagine that. Okay, that's whoa. Yes, currency swap. Okay, it's the same that interest rate swap, except that the flows in interest rates are in different currencies. You exchange interest rates in 2 different currencies. Let me explain, give you an example. You are, okay, some years ago, I remember many US firms in debt in dollars paid an interest rate which was higher than interest rate in yen, the Japan currency. Japan currency interest rates were close to 0, as you know, and the US dollar interest rates, what some years ago were at a higher interest rates, maybe 4%, over a 10 years horizon. And some corporate treasurers in United States say, "Whoa, that's stupid to pay a higher interest rate in dollar, as Japanese people pay only 0.5% per year. I will make a swap, paying Japanese yen, receiving US dollar. So your debt remains on your balance sheet in dollars. Each year you pay interest rates in dollar. But in the swap, you pay yen interest rate each month, each year, 0.5% in yen, and you receive, for instance, 4% in dollars. So flows in dollars cancel, offset, because on your debt you pay interest rates, on the swap you receive interest rates in dollars, but it remains that you pay only interest rate in yen. What happens? You just have changed your debt from dollar to yen. But be careful, be very careful. Stop dinner. Set your fork, your knife on the table. Stop dinner. If you make a currency swap, be careful. You have, at the end of the swap, to reimburse, in fact, in yen against dollar, because, in fact, you have changed a debt in dollars against a debt in yen. So you have to reimburse the debt in yen. And if the yen against dollar has moved a lot up, more than the differential of interest rates during each year, you can lose a lot of money. You have, in a currency swap, an exchange rate risk. It's difficult because we will see that after, and I will use other tools because here I cannot write on my screen, and I will try to use tools which allow to write on the screen. But just if you can, if you make a swap, a currency swap, you exchange flows in your currency against flows in another currency, but be careful, at the end of the currency swap, you have to pay capital. And if you made a swap in yen, paying yen, receiving dollars, you have to reimburse your capital in yen. And if the yen has moved up against dollar, more than the cumulative differential of interest rates, you can lose a lot of money. Be careful with currency swaps. Today, we did not see that in details, but if you just can keep in mind that you have an exchange rate risk in a currency swap and not in an interest rate swap, it's already very good. Okay? Commodity swap, what it is? A commodity swap, normally you exchange a fixed price against a variable price. Let me give you an example, which is a real example. In 2008, it's during the subprime crisis, before the Lehman Brothers default, the oil price moved up a lot. And the oil price, energy price, moved to $120. $120. My story is a real story. At this time, in June 2008, Air France, which is our domestic airline company, said, oh, the oil price is very high, 120. If the oil price moves up again, we will lose a lot of money. Maybe we should lock in the price of today, 120, during the 5 following years. How can you lock in a price during 5 years, buying each month during 5 years? Either by buying forward during 5 years, oil, so you call your bank or you go to the Chicago Mercantile Exchange and you decide to lock in today the price at which we will buy oil in 1 month, 2 months, 3 months, 4 months, each month during 5 years. Each 5 times 12, 60 forward contracts. Or you call your bank, Vietcom Bank. I think it exists, Vietcom Bank. I don't know if it exists. I suppose it exists. I remember. You call Vietcom Bank and you say, okay, I would like to make with you a swap, paying each month a fixed price for oil, and I receive from you, bank, the spot price observed on the market. Paying fixed, receiving variable price for oil. That's a swap. 60 clearing operations each month. You pay fixed, you receive spot. You pay fixed, you receive spot. Just an illustration. Imagine that 1 month after you enter a swap with Vietcom Bank paying $120. 1 month after, the spot price has moved to 130. What happens? The Vietcom Bank gives Air France $10 because Air France pays 120 to Viet Bank and receive the variable price, the spot, which is 130. So the Vietcom Bank pays 10. And Air France buys its oil on a $130 basis, minus 10, it's 120. Okay, you lock in 120. If 2 months after, the price has moved down 100, for instance, you pay, Air France pay 120 to Vietcom Bank, Vietcom Bank pays 100, so in fact, Air France pays 20 to Vietcom Bank. But Air France buys its oils at 100 on the market. 100 plus 20 is 120. Okay, so the swap, the commodity swap, allows a company to lock in a price over X year horizon, 5 years in my example. But what happens after? In December 2008, and you can check on internet, that's true what I am telling. The oil price has moved down a lot, crashes to how much? $40. $40. So Air France, who entered the swap paying 120 each month during 5 years, in December has a swap paying 120, receiving variable, when the new swap pay 40 only, receiving variable. So Air France has locked a price of 120, and now the oil price is 40. Its competitors, which German competitors, Italian competitors, what do they say? They say, oh, I did not make a swap. Now I buy oil at 40. And Air France now buys at 120. It will lose a lot of money. I can move down my prices, my tickets, if I am a German company, because I am sure that Air France cannot move down its prices because it buys oil at a too high a price. And Air France will be dead. What did Air France do? Air France contacted its bank and saying, okay, I would like to cancel my swap. I pay 120 each year, and now the price is 40. I am dead. And the bank said, okay, I am able to cancel the swap, to break the swap, but not for free. Not for free. Airline company of France, you have to pay. How much? Now the new swap pay $40 over 5 years around, instead of 120. Air France, I will cancel your swap, but you will give me the market value of your swap, paying 120 instead of 40. You lose $80 per year, so you will pay me $80 per year per month. Per month over around 5 years. It has been a huge loss. Air France airline company decided to break its swap, stop it, to resell it to the bank, but it received a loss, which was around 3 billion euro, roughly $3 billion. And if you look at the financial accounts of Air France company, airline company, in 2008, they lost a lot of money, huge loss. Why? In the financial accounts, they explain that they were obliged to break a hedge, a swap, and that they had a loss, and which explain the global loss of the airline company. So be careful. If you make a commodity swap, paying fixed, you have a risk. If the price moves down, you can lose a lot of money, opportunity cost. Understand that? Very important. And what I am telling about oil, you can apply to every commodity. If you want to, if you want to look in, for example, wheat price for 5 years, you can make a swap, paying wheat price, fixed price, receiving variable price, spot price. Be careful, if the wheat price moves down, your swap will be really a bad swap because you pay a too high price. So I have a question for you now. For people who don't sleep, maybe you are 42, maybe 35 are sleeping. 35, 5 are have their dinner, 1 is watching TV, and 1 is listening to the course. No, that was a joke. All of you are listening to the course. I have a question for you. Air France made a swap, paying fixed oil $120. Some months after, the price moved to $40, and its swap was a very, very bad swap. What was a good solution Air France should have done instead of making a swap? What is the financial derivative that Air France should have bought instead of entering a swap? Please answer by chat, or if you want to speak, that's a good idea. Already. He's very good, this guy. T2 Yen Nguyen. This guy or this lady, I don't know. T2 Yen Nguyen is, I am a lady, sorry. Okay, it's difficult for me. Are you working in a bank? Or are you working in a bank? Yeah. Okay, so you know that very well already. Are you working in a capital markets department? Good. Okay, Standard Chartered in Vietnam has good colleagues, because I can say now she instead of he. She answers very good. Long call option, yes. Instead of making a swap, you should have buying an option on swap, which has a name. It's what we call a swaption. Maybe I can write swaption. Oops, swaption. Okay. It's instead of buying a swap paying fixed, you buy the right to make a swap. And when the oil price moves down to $40, instead of paying $80, 120 minus 40, you say, oh, I have the right to pay 80. I don't pay. That's a swaption. Or instead, that's the same thing. You buy call options. Call. I buy the right to buy the oil at 120. If the price moves down, I don't buy. If the price moves up, I buy at 120. So the answer given by the Standard Chartered colleague was very good. You can either buy a series of long call options or you can make a swaption. Okay, that's same thing. Very good, very good, very good. Okay, equities. Okay, an equity swap. You exchange the return on an equity index against, for instance, an interest rate. You say every month, if the equity index has moved up, you will pay me the difference. I will pay you the interest rate. And if the stock index will move down, I will pay for you. I will pay in my swap. Okay, so it's you exchange the return on a stock index against an interest rate. And then a credit default swap. I will show you some quotation for credit default swap. You pay each month, each 6 months flow, and in case of default, you receive the nominal value of the bond, as I explained earlier. Wait, that's a swap, but maybe I will come back on the swap. Okay, I don't have any quotation for credit default swap here, but okay. Maybe some question about the seminar's introduction, just for make a break to be sure that everything has been okay. First question, what are the different segments of the capital markets? Maybe you can answer by chat and after we go question by question, okay? Who is writing? That's very easy question, but it's good for understanding capital markets to have a on my screen. Some people are okay. Spot, futures, forward, swap option. Very good. What is the bid-ask spread? Okay, we did not speak about that. Maybe okay. Maybe we go. No. Primaries and secondary market. Bid-ask? No. Okay. Okay. Sorry, because I have some phone calls. Sorry. I just answer. Okay. I will ask the question after answer bid-ask. What is the normal relation between the spot price and the futures price? Write the equation. Futures is spot plus interest rate plus rate. Perfect. Normally, if you want to be perfect, you are close to be perfect. But if you want to be perfect, it's minus drawback. That's good. Minus globally what we call backwardation. But I will explain after what is backwardation, and it's linked to the drawback of holding the commodity. That's very good, the answer. Okay, to have the perfect grade mark here, you have to write futures price equals spot price plus interest rate plus storage cost minus backwardation. If you put minus drawback, it's the same thing. It's perfect. Okay? Okay. I will explain after why it's the same thing. Can we trade better on the futures market? Is the normal price curve increasing or decreasing? Yes, increasing. Tui is a very good expert in butter. Very good in butter, on the butter market. She knows very well the butter market. Why? Because if you want to buy forward butter in 9 months, you can borrow, buying spot, and store the butter. The forward price is equal to spot plus interest rate plus storage cost. Okay. You hold a portfolio of equities and are anxious about a new financial crisis. How can you hedge your portfolio? Who call a put option? A long put option. You hold. Ah, okay, I understand. Okay, I have a first answer. Long forward. Okay, T2 Hing and Nguyen. Sorry, I'm in short forward. I was very surprised because she is very good. Yes, she's very good. Okay, if you hold a portfolio of equities and you want to hedge, what are the solutions? Okay, you have a lot of solutions given by derivatives. First, you can buy a put. What your colleague says, long put. Long to be long. Maybe some people who are not working in banks don't understand anything. To be long, what does that mean? To be short, what does that mean? Okay, to be long is to buy. When you buy something, when you hold something, you are long. When you sell something, you are short. When you have to buy in the future, you are short. So to be long is to hold or to buy. Here, when you TWI says long put, it's I buy a put. You have a portfolio of equities. You buy a put, that means I buy the right to sell my portfolio at a given price. If the market crashes, okay, the value of your portfolio decreases, but you have both the right to sell it at a given price. So you can sell it at a given price and you don't support the decrease of the value of your portfolio. So you buy, you put, it's a good answer. We will come back about using options in the future. But buying a put, I would like just that everybody understand why when you hold a portfolio for hedging, you can buy a put. I buy the right to sell my portfolio at a given price. At the today price, for instance, if the spot price moves down, you have the right to sell at the today price. You don't support the loss. Okay, long put, good. Not long forward. Okay, sorry, I mean short forward. Sure, short forward. That is, you sell forward your portfolio. So if the market moves down, okay, you have again because you sold forward index, stock index, you buy it at a smaller price and you have a gain, which offsets the loss in your portfolio. We will see that. That's just principle of hedging. That's good. Another answer would have been to make a credit default swap on a portfolio of equities. You pay to the bank an interest rate each 3 months, and in case your portfolio moves down, you ask the bank to pay you the difference. Okay, that's also a way of hedging. Is buying a call the same exposure as I'm saying a put? The answer is no, but I will explain after. Well, cash statement, physical statement, I did not speak really. What is the difference between forward and futures? Question 9. Yes, on the futures market, you trade on an exchange, and the contract is, as your colleague says, standardized. That is in terms of expiration dates, in terms of amounts, and you have to pay what we call an initial margin, margin calls every day. So I did not go in these details. People who work in bank know very well. I see these kind of things, but today just explaining the principle of using capital markets. I have a question about CDS, which is not the question 10, because what is a credit default swap? You know what it is. Let me ask you a question. If you buy a credit default swap, you don't have any bond. You don't have any bond in your portfolio. You don't have any bond. You just buy a CDS, for instance, on a Greek bond. A lot of people in 2011, before the Greece default in 2012, the country, Greece defaulted in 2012, and some months before, a lot of people without having any bond, Greek bond, bought a lot of credit default swap, what we call naked credit default swap. That is, you don't have any bond, but you buy a CDS. What is your exposure? What do you do if you buy CDS on a bond you don't hold? For instance, after the session at 10 o'clock, the US, today it's Labor Day, I think. So, but tomorrow morning, you buy CDS on France, my country. You buy CDS on a French bond. Why? What happens? Oh, Standard Chartered. Maybe Standard Chartered has to make the lesson to my place because she's very good. So you have to make the lesson. I see it's kind of gambling, right? If you bet on the chance that the crisis shall happen, sure. Maybe I would like something. I think it's very difficult. Can this lady, who works with Standard Chartered, explain orally, speaks orally to to the classroom her answer, because her answer is very good, but I would like that to explain what you said. It's a gambling on the default. Thank you. Professor? Yes, explain.
Yeah. Actually, the CDS is a kind of contract which you bet on an opportunity if that stock can be can be decreased. The stock price or the price of underlying assets can be decreased. So in case the stock market the underlying assets is not decreased, so you will lose the premium fee of that contract of the CDS. It's kind of the like insurance fee you pay for the bank to issue that CDS for you. So in that case you will lose the premium fee. In the case you won, you will take on the gap of the underlying asset which has been already decreased.
That's perfect. Okay. 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 I cannot say in better terms. I illustrate with the Greek situation. In 2011, a lot of people bet that Greece was going to default. Greece, okay, on its bonds, and a lot of traders in the world, decided to buy CDS without having the bonds, not for hedging, just for betting. What happens? They say, I will pay each 6 months, maybe 1%, 2% of the nominal value of a bond. For instance, nominal value is 1 million. I will pay 1% of 1 million each 6 months, for instance. And in case of default for Greece, I will receive from the bank, which is the CDS seller, I will receive 1 million euro. As your colleague says, very good. It's a financial asset, but it's like an insurance. You pay, and in case of disaster, it's default, you receive the nominal value of the underlying asset, the bond for the Greek bond. So it was very interesting because a lot of people bet on Greece default, and they pay a premium, what we call a premium fee, and that's exactly good, 1%, for instance, each 6 months. And as Greece defaulted 1 year after, in 2012, they received a lot of money from banks. But be careful, that's very interesting. And that's an illustration of the connection of the markets. That's not the only problem raised by this story. When people bet on Greece default, they bought CDS to banks. The banks was CDS sellers. The bank has a higher risk, a big risk. The risk is that Greece default, because if Greece default, they are obliged to pay 1 million and they just receive 2 times 1% of 1 million. So they lose a lot of money. What do the banks do as Standard Chartered? They hedge themselves. And they say, I lose a lot of money if Greece default. So I will hedge. How can I hedge? I will make money if Greece default. That's hedging. Because if Greece default, I lose money on my CDS because I sold the CDS. I have to pay 1 million to the CDS buyers, the guys who bet Greece default. And so I have to make money if Greece default. How can I do? I sell forward, be careful. I sell forward bonds, Greek bonds. If I sell forward Greek bonds, and if the Greece default, the price of the bond will move down. I will back the bonds and I will make money because and the money will offset my loss on the CDS. To be precise, what did the bank do? The bank sold CDS to CDS buyers. The CDS buyers were speculators who bet on Greece default. Banks sold CDS. For hedging, they borrowed Greek bonds, to be precise. They borrowed bonds. They did not borrow money. They borrowed bonds from people who had bonds. They sold on the spot market the bonds. They sold spot. And when Greece defaulted, the bond prices moved down, for instance, to zero. They buy back the bonds at zero. They sold on the spot market at the beginning at maybe 100, okay? And they gave, because they borrowed the bond, they gave it back to the bond lender. And so the bank were perfectly hedged because they sold spot, the bond, when they sold the CDS. But, and this is the end of my story, what happens if people buy CDS? First step. Banks sell CDS. Second step. Banks hedge themselves. Third hedge. They hedge themselves by borrowing bonds and selling them on the spot market. Fourth step. But when you sell bond spot, what happens? The bond price moves down. And if the bond price moves down, the interest rates on the bond move up, as you know. What happens? The Greece is obliged to finance itself at a higher interest rate because the bond price has moved up, the interest rate has moved up, and so the Greece has to pay a very high interest rate on its debt. It cannot do that, and it's default 2012. So, in fact, default of Greece has been explained by the behavior of speculators who bet on the Greece default through the CDS, buying credit default swap. Because don't forget something. When someone buys something, someone sells something. When we say speculators bought CDS, you have to say, oh, who sold CDS? Banks. And you have then to say, but when bank sells the CDS, what does it do? Because it's very risky. You receive the flow and you pay like an insurance company if Greece default. You cannot keep this exposure. It's too dangerous for the bank. You hedge. You hedge by selling the bonds. Because if you sell it at to the price and that Greece defaults, you will make money because you will buy back at zero what you sold today at, for instance, 100. So you borrow bonds, you sell them. But if you sell them, the price, as someone says, goes down. And if the price goes down, the interest rate moves up. So for finance, when the Greece borrows on the financial markets, on the primary market, interest rates has moved a lot. If you look at the story, at the moment, interest rate on over a 10-year horizon for the Greek debt was around 25%. The Greece could not borrow with 25% interest rate. And what does happen? It defaulted in 2012. So it's the reason why the regulators, after this story, decided to forbidden to buy what they call naked CDS, naked without suits, naked. So that means if you don't have bonds, you cannot buy a CDS. So if you think the France, my country, will default, and that you want to bet by buying CDS on France, you don't have any bonds, French bonds, but you want to make money if France default, you cannot more. Sorry for you. It's a very bad news for you at the end of the session. you cannot buy CDS on France because you don't have the bonds. If you have bonds and that you want to be protected against a default, you can buy CDS. Okay, so that's very important, this story of CDS. Okay, and okay, have you understood what I explained? Do you want some more explanation? That's very important because it's another illustration of the connections of all the market. You know, buying CDS is selling, hedging is selling, is borrowing bonds, then selling spot. So if you sell spots, interest rates move up, all the markets are integrated. Okay, have you? Oh yes, I have a. Someone is writing. The bonus, okay. I am. Yes, so it's kind of butterfly effect. Yeah. Yeah. Sure. A small and a very big effect. Yes. Okay. I look. Okay. Maybe in 11 minutes we stop. 11 minutes. It's very short. 11 minutes. Okay, so a quarter before the end. Donc, we stop with some other small exercises. You are a cookies producer. That's very good, a cookies producer. And you have to buy 1,000 tons wheat in 3 months. You decide to use options. Which strategy do you implement? Buy a put, selling a call, selling a put, buy a call. TUI is buying call. The TUI is very good. TUI, where are you working? In a bank? TUI does not answer. TUI? Oops. I work company of Berkshire Hathaway. It's a financial company or nothing to do? Okay, so okay, it's a concern. Oh, okay, good. Okay, fine. I am happy to see that people working in a construction area are very good in the finance area. Okay, you buy a call. You buy the right to buy the wheat at a given price. So if the wheat price moves up, as we observe since some months, you buy it at the given price, at what we call the strike price. But if the wheat price moves down again, you will buy it at a lower price, you will make profit. So you buy a call was the good answer. Very good. Same question if you are a US importer to have to pay 1 million euro in 3 months, what do? Buy a call, sell a call, buy a put, sell a put. Question is too easy. Buy a call on euro or buy a put on dollar. Very well. Okay, if some of you, because some are very easy on this session, you don't hesitate to say I don't answer the answer. Okay, because okay. If the US importer buys a call euro, strike 1.20 and maturity 3 months, who is the seller? Very good question before the break. Who is the seller? How does the seller hedge? What do you observe on the connection between market segments? Okay, we will stop by that because it's a very interesting question. We will not have the time, and it's not today the opportunity to go in details because we have a lesson on options specifically. But for everybody, who is the seller? It's very important. Please, before sleeping, think something. If someone buys, someone sells. You cannot say the market is buyer. No, if the market is buyer, the same quantity of people are sellers. So that's stupid to say the market is buying or selling. You have the same quantity of people buying and selling. So if someone buys, that's very important to say who is the seller and what does the seller do? Does it speculate or does it hedge? And if he hedge, how does he hedge? That's very interesting to understand the dynamics of the capital market. So we break after this question. I look at my chat. I hope very well that some of you will speak. We spoke some minutes ago to say just hello. You can just speak and say hello, but you can also answer the questions. Okay, who is the seller? The US importer buys the coal. Okay. First answer, seller is the bank. Yes, sure. When you buy an option, you buy to the bank, and the bank is the seller. Okay. So how does the seller hedge? Seller sold the right that we buy euro at 120. What is the risk of the seller? What is the risk? If the euro goes down or goes up? What is the risk for the bank? Even for people who are not familiar with that, someone is buying a call on euro, is buying from you the right to buy from you euro at 1.20. What is the risk for you if you sell this option? What is the risk? The risk is euro increasing. Yes, sure. If the euro increase, the buyer of the call will ring at the bell of the bank and say, oh, I have the right to buy from you euro at 1.20. Look at the price, the spot. The spot is, for instance, 1.50. Say, hey, I have a gain of 30 cents. The difference between 150 and 120. So the bank has a risk, loses money if the price moves up. The euro moves up. So second question, how does the seller hedge? If you want to stop at 45, maybe some of you are invited to answer. What is your risk? What happens if the price moves up? The bank loses money. Nobody wants to answer. The answer is not very difficult. As you have a risk, if you have a loss, if the euro moves up, the bank will buy euro. Because if the euro moves up, you will lose money on the option, but you will make money if you buy forward euro. You buy forward. Oh, yes, you buy forward. Yes. Okay, we will see after that. Just we are on the principle. Okay, just which quantity? In fact, if you think after we make that with some mathematics, if we think that the probability that the euro dollar moves up is 50%, because you assume that the statistical distribution is Gaussian, normal. The expected value is the forward price, and you have 50% that the price is higher than what we call the median, okay, close to the expected value, equal to the expected value in the normal distribution. So you have 50%. So if you have 50% to lose money, instead of buying, if you sell a call on 100 million euro, on 1 million euro, you buy half of the quantity. That is 500,000 euro. So what does the bank do? If the bank sell an option, a call on euro, the bank buys euro. And what is the last question? What do you observe in the connection between markets and segments? Oui. Oui, do you want to speak? Say hello, or to give us the answer? Yes, they are connected to each other. But more than that, that's okay, that. But more than that, some of you are writing away. Yes. Okay. Just for closing the session, we will see that again. Okay, sure, that we cannot do that in 3 hours. So many things. But the idea, imagine the people is speculating on the euro. Traders think the euro will move up. Okay, that's the bet. Someone spoke about bet. It's a bet. Imagine speculator says the euro will move up. I will buy a call, because if the price is the euro moves up, the price of the call will move up, or you will make money. So people bet that the euro will move up. They buy call on euro. Second step, who is the call seller? The bank. The bank sells the rights that we call, that we buy euro at 1.20. He loses money if the euro moves up. For hedging, the bank buys euro. But if the bank buys euro, what does the euro do? It moves up. It moves up. What does that mean? And the speculators make money. That means that, be careful with that. If you want that the euro moves up, you say, I buy calls. And I say that if I buy calls, bank will buy euro, and that the euro will move up. On markets very large like euro dollar, this effect is not very important. But if you look at equities on small markets, I can tell you that if you want that the equity price moves up, if the quantity traded is low, you buy calls. And you know that if you buy calls, banks will buy the equity. And if they buy the equity for hedging, the equity price will move up and you will make money. So the idea, the final idea is these markets are connected, as Tui told us. Okay, you see that on many illustrations, we saw that all these markets are connected. Okay, so that was the first session, just an introduction, just some basic ideas, but I hope you enjoy a lot, or small, or not at all. Okay, you will tell me that. Don't hesitate before dinner or before what you want, watching the TV, sleeping, to give me some chat with hopes if you want to change something, if it's too quick, too low, you tell me that's okay, that's not okay, because it's there. Okay, so my hope is that you spend 1 minute to chat, to send some chat with your opinion about the first session, and we meet us on, I think it's Wednesday. Okay, Wednesday 9. Okay, so have a good sleep. Don't forget to send me a message, and after I wish you a very, very nice evening. Okay, bye bye.